Did you know you can have the best stock pickers invest for you? This can be done with mutual funds because you can utilize their knowledge to invest for you. You no longer have to know anything about the stock market to beat the returns of the overall market. In this video, I will be diving into what a mutual fund is and how it can change your life forever.
Is it Brian? Yes.
Hi, I'm Giannino. I teach you how to make money, grow money, and invest money. So please like this video and subscribe to my channel. I would greatly appreciate it. A mutual fund is a type of investment. Just like you would buy a stock or an index fund, you can buy a mutual fund on the stock market. But mutual funds offer a lot of unique advantages that stocks and index funds do not. For one, a stock, when you buy it, you are married to the returns of that stock and the performance of that one stock. Your whole portfolio is contingent on the success of that one stock. With the index fund and the mutual fund, you have diversification. Both of those hold a wealth of stocks, up to 300, maybe even 1,000 stocks. This allows you to not be married to the returns of one stock or the downfall of one stock. So this diversification offers safety. I won't go in depth. I talk about this all the time. But here's where it gets interesting, because the index fund tracks the overall market, gives you overall returns. Back in the day, way long ago, one person was way too greedy. They wanted to beat the index fund. They said these returns aren't good enough. So they made a mutual fund to beat the index fund returns. And that's all a mutual fund is trying to do, is give you better returns than the overall stock market, the overall index funds out there. So back in the day, one greedy person sought to do this, but now we have a bunch of intelligent investors that are managing these funds well and outperforming the market for decades, sometimes even centuries. So mutual funds are great places to put your money, and most importantly, grow it faster than the overall market would. So right now, I'm going to dive into the advantages and disadvantages of buying a mutual fund. And at the end of the video, I will give you 3 steps on how to pick the right one for you, the safest mutual fund. So the first advantage is that a mutual fund is actively managed, meaning one person is looking at a certain amount of stocks and deciding if he wants to add more, take out more. So by having one person or a team of people deciding what stocks should go in or out at any moment, you can capitalize on short-term moves and, more importantly, beat the index. Because when somebody is actively managing something like a fund, they can beat something that is passively managed. So you may not know this, but the SPY 500 is an index fund, and index funds are garnered by rules of how stocks can get in or out. All the rules are meant to do is show the overall returns of the economy and follow the economy really closely. The downside is that these rules decide what stocks go in, but most stocks stay in there for long periods of time. So these funds, these stocks aren't traded, these stocks aren't moved too aggressively. That's why the returns aren't that great compared to mutual funds, because when you have somebody always monitoring, always switching positions, this allows you to easily beat the returns of somebody not putting too much effort in investing, because they don't really have a choice. They have to follow what stocks follow certain rules to get in and out. Think about it like this. If you run a business and you want to grow your business, if you just open up a store on the side of your street and expect to have a lot of customers and your customers growing all the time, it's not going to happen, because word of mouth only travels so fast. If you want to grow your business faster, you have to actively do something. Put out ads on the internet, put out ads in the paper, put mail in people's mailboxes. You have to actively do something to grow your business. Just like mutual funds have to actively manage that fund to have better returns. More effort sometimes equals more returns. So that's the first advantage of a mutual fund. Now, this is actually a double-edged sword, because although actively managing something can be good, it can be terribly bad for somebody owning that mutual fund, because if you trust some schmuck you don't even know, he might lose all your money. So you could have that whole mutual fund go straight to zero. This is why you have to do the research and understand if they are worthy of your investment. The next advantage of a mutual fund is you have the whole history, you have their track record online, so you can instantly know if they are worthy of your investment. So it doesn't take too much time to know which mutual funds are good, which mutual funds were bad. You should be looking at a 10 to 50 year track record. If you're investing something that did well for 2 years, you're going to lose all your money trusting those people. The next disadvantage of a mutual fund is the fees associated with it. This is called the expense ratio. So the percentage you have to pay per year for them to manage your money. And this is pretty bad when you think about it, because if they don't do well, you still pay them. If they do well, you still pay them. So this isn't really incentivizing them to always do well for you and have your money grow for you if they get paid no matter what. So this isn't too attractive to me, but the high expense ratios are only because these people are actively managing the fund and managing your money. So they have a whole team of people they have to pay. They have buildings that have rent. Index funds do not. They don't require much maintenance and much movement with the stocks, and the mutual funds do. They require tremendous amount of research and tremendous amount of overhead. This is why they cost you, and this is why you can see that expense ratio being pretty high. Check out the chart here that can kind of show you how a high expense ratio can lower the amount of returns over long periods of time. So this chart shows you that the overall index beat every investment on the chart. A high expense mutual fund was the worst performing investment you could have chosen in this graph here. So kind of showing you the downside of investing in a high cost mutual fund. Now let's get into the next advantage of a mutual fund. This is why they're so exciting. This is why I love them, is because they can invest in different sectors, different countries, and invest in more different types of things. So you're basically hiring someone that knows a lot in that sector. Maybe they're the best guy that knows lumber and lumber investments, lumber stocks, and you want to be involved in lumber for whatever reason possible. You can find a mutual fund that holds lumber stocks. The reason you would do this is because maybe you're a terrible stock picker, and if you picked a lumber stock, maybe it would go straight to zero. So if you want the diversification of owning a couple lumber stocks, you can do this in mutual funds. You can also invest in different countries, emerging markets. You can invest everywhere. Mutual funds are super exciting when you look at the possibilities of where you can put your money and how specific you can niche down and own. The next disadvantage of a mutual fund is the minimum amount to invest, because some require you to have $3,000 invested or even $1 to $5 million. Some of the best mutual fund hedge fund managers require $1 to $5 million from their clients to put in, and most of the time you can't take this money out for a specified period of time. All this is meant to do is make sure the people that are putting their money in is serious, and most importantly, they're not going to be taking it out at the wrong time, and they're people that trust them. Because really good mutual funds can have great track records for 5 years, and they have a bunch of people that want to give them money. So that's why they set the minimum, is to weed out the people that don't belong with them. And here's why you're watching this video. These are the 3 steps to find the safest mutual fund you can find. So I just want to let you know I'm not a financial advisor. This isn't financial advice. I just want to give you the best education possible so you can make the best decisions for yourself. So step number 1 to find the safest mutual fund is find one with an expense ratio below 1%. And the lower the better is what you should be shooting for. So in this picture you can see where you can find that. It's just called expense ratio, and this can be found on many common websites if you just type in the mutual fund you're looking to buy. Once you find a mutual fund with a low expense ratio, the next thing you want to do is look at their track record, not just for 2 to 10 years. Look at their track record for 30 to 40 years. You want to find a mutual fund that has been around for a while, is stable, and has consistently outperformed the market. In this picture, you can see it is obvious that this mutual fund since 2002 has outperformed the market. So this looks like a great opportunity, and their expense ratio is low. So this would be a mutual fund I will write down on my list, because they can give me an extra 2 to 3% per year, and over 10 to 30 years, 2 to 3% really adds up. And then step number 3 to find the safest mutual fund is make sure they're diversified, because when they hold stocks, if they own too much of one stock or too much of one sector, that can put your whole portfolio in ruin if that one sector does bad. So what you want to look for is a mutual fund that does not put more than 15 to 20% in any one sector or 3 to 10% in any one stock. The mutual fund I found right here has 15% in their largest sector, and they have 3% in their largest stock, Microsoft. So this is a great mutual fund that is fully diversified and safe for you to invest because they're not over leveraged in any one stock or any one sector. So just to recap, we're looking at the expense ratio, making sure that is low, and then we're going to look at the track record, making sure they're consistently outperforming the index. And lastly, we're going to be looking at diversification, making sure they're not putting too much money in any one thing or any one sector. The fact that a mutual fund can outperform an overall index and still be diversified is so amazing and so attractive for me as the investor. But what I want to show you is my best dividend investing strategy that will change your life. Make sure you click the video to the right of me. All those bills coming in, what if you didn't have to worry about them? What if you could create enough passive income to pay all these bills each month? One way to create passive income to pay all your bills is through dividends.